Welcome, everyone, and thank you for joining us. A presentation today of our most recent investment opportunity. My name is Robin Massey. I'm the Senior Director of Investor Relations for Club Capital. And joining me today is Darren Davis, the Principal of Club Capital.
Thank you. Looking forward to talking with our investors and our developer friends.
Yes, absolutely. Well, let me get the legal part out of here so we can move on with this. But this presentation is for informational purposes only. Any investment opportunity discussed in this presentation is offered under SEC Regulation D, Ruling 506C. On to the good stuff here. Yes. So Darren, tell us today, you have kind of this unique perspective. You as an investor, as well as through professionally your businesses, have encountered multiple downturns, market turns through commercial real estate. Can you kind of give us a little glimpse into what we're going to kind of hit on today through your perspective?
Yeah, so you're being really nice and saying gray hair. Right? Okay, so no, but the experience is I think a big piece of what I want to share today, and kind of some of the cycles that we've gone through, and what I think with a lot of knowledge, what I think is going to happen going forward over the course of the next really 3 to 5 years. But we are going to be talking a little bit about this, maybe not a very familiar name in preferred equity. We haven't needed preferred equity in the last 12 to 15 years. So it's something that might be a little new. We'll kind of define it. We're going to share with everyone on this webinar right now the value that it brings to not only the developers, but the opportunity it brings to the investors.
Yes.
And so it really is a unique position to be in. And, we have a pipeline of these deals coming in, and I'm going to share with the group why that's happening and how I think it's going to probably have about a 2 to 4 year cycle. And that all depends on what the Fed does and what the economy does and where inflation goes. But I think based off of what I'm seeing, what I'm hearing, and my past experiences, we're going to have a nice opportunity here for at least the next 2 to 4 years. Everybody hears history repeats itself. Okay. I mean, elementary school teachers all the way up to your mom and dad. Okay. They tell you that. And I've always liked to cut the grain a little bit of the opposite direction sometimes. So I'm always looking for something slightly different than, just run of the mill quotes. But I like a lot of things about Mark Twain. And history never repeats itself, but it sure does often rhyme. And I think that is so true. You're not going to get a carbon copy of maybe what happened in 2008, 9, and 10, but there's a lot of similarities. And actually, I'll give you one little just quick one. I think 2008, 9, and 10 were devastating to the market, to people, to the economy. We're not in that environment. However, we're experiencing in the real estate investing and development and acquisition and disposition world of commercial real estate, we've got some challenges. But again, it is nothing like then. But I do see those little nuggets of opportunity, and that's where I say it rhymes. Okay.
Yes.
So, all right. Well, I want to first talk about kind of level set to where I think we are today. And this is pretty straightforward, and everybody knows this, but I just wanted to highlight a few things. Transactions in 2023 literally, I think, bottomed out. I know for us, we literally kind of sat back and said, nothing pencils. We can't make the deals work, so we're not going to do them. And there is that one, 1 in 10, 1 in 20 opportunity that does work. But for the most part, activity, buying, selling, constructing, everything because of debt and leverage and interest rates and inflation, it literally just ceased. We saw, numbers going down 30, 40, 50, 60% in applications, permit, transactions, everything. Most new developments just couldn't get financed. And I mentioned debt and equity. The debt numbers, 4 years ago, in some cases, we could get 75 to 80% leverage. Today, 55, 60% leverage. So things like that will cause you to pause and not take that unnecessary risk on that, because the reward's just not there. Development costs and operations continue to increase. I think based off of where we are today, I am finally starting to see some numbers starting to level off in pricing and labor. So I think 24, we still see some increases, but I think by 25, because there's been so few starts and so few transactions. There's a lot of hungry general contractors, and there's a lot of suppliers that need to start moving product and services to get to make their businesses work. You know, the indexes are substantially higher. You know, a lot of people, we'll talk about that a little bit later, but a lot of people have construction loans or loans that were maybe floating in that 3.5%, 4% just 3 years ago. Those loans may be coming due in the next year or two. Well, those loans right now, instead of being 3.5% and 4% on a floating rate, are 7.5%, 8.5%. So that's a significant jump in your interest cost. You know, maturities continue to grow. We're going to talk a little bit about what's happening in 24, 25, 26. We'll see that slide a little bit later. And I think we've peaked with interest rates and inflation. But I told people this 2 months ago, 4 months ago, 6 months ago. Even if we were to receive 75 basis points, 3 rate decreases, you know, 25, 25, 25 in the next 6 months or so, that's not going to move the needle. Yeah, you got too many other things going on. If it was just interest rates and that started happening, pretty good, but not with everything else that's going on. So I think be prepared. I don't think 24 is going to be this. I mean, 25 is going to be a breakout year. I think 24 is going to get a little better. I think the back half of 25 is probably where you're going to start seeing things really start to come together, that we have that confident to move forward on several projects that we may not have wanted to move forward with. And that's for developers, and we fund developers and investors, but we do have some opportunities in the interim. So we'll talk about that.
Yes.
So
don't sit on that money.
Yeah. So, well, and this is, I got to give, I just saw Kristen Matthews, who works for John Burns Research and Consulting. I copied this. This is hers, but I love it. And I love it for the fact that I've hit every one of those points on that graph. Okay.
Anybody that's owned real estate.
Yeah.
Honestly.
Yeah. And I am a carbon copy of that in 2008, 9, and 10 completely. And I learned my lesson. All right. And if you look at this, you know, this maximum financial risk and opportunity and euphoria and depression. If you look to the bottom right, we've got Mr. Sad Face there. I really believe we're somewhere in that hopelessness and hope in the bottom of that curve. And the thing that I learned the most is when everybody is doing one thing, like in the top left on euphoria over there. We were talking in this office 2 years ago. We can't believe some of the things people are doing.
Yes.
And we remember 2007, 8, 9, 10, and we're going like, wait a second, the feeling is starting to come back. And, you know, we've had that firsthand experience. So I wish, the one thing I regret, not one, but several, but one thing I truly sticks out in my mind about where we are right now is I didn't, as an individual investor and as a sponsor, business owner, I didn't catch that wave down at the bottom and start going up. I didn't start really going up until about 2016. And all of my friends and people I know that started going in the bottom of that wave in about 2012, those guys between 2012 and 2016 made a fortune. So I think we're probably within the next year to year and a half, when you get into that hope section to the bottom right over there, maybe the worst is over. I think we're going to be trending in that direction in the next 18 months. All right. Now, what do we talk about all the time?
Data.
Data matters. Yeah.
Data matters.
It really
Absolutely.
does. So what I do feel very fortunate for us, because there are some parts of the country that are thriving. There are some parts of the country that are maintaining, and there's some parts of the country that are just not exciting. Okay. We're fortunate that we work primarily in Texas and in Florida, and those are two states that are incredible business climates. The economies are strong. So there's lots of good things to say about both of them, but let's go into some of the numbers here. So we've all been hearing about the migration since the pandemic started. And if you look, this isn't too exciting here, but this is United States Census Bureau But I want to point out something, the Southeast, where you see Florida on the bottom right, and Texas, and both of those in green, those where you had those states, or all of that in the darker green, is where we had the largest net migration. So you can see the states where the changes have started happening, and Texas and Florida are leading the country. And we'll get into those numbers here in just a second. And if you put Texas and Florida together and you look at the net migration in 22 and 23, that represents 58% of the top 10. Okay, so you can see the Southeast over here. You've got North Carolina, Georgia, South Carolina, Tennessee, the Sun Belt, Arizona, Virginia, Colorado, Utah. All of those states had net migration, but the two big kahunas, Texas and Florida. And quite frankly, they're projected to maintain that status for the foreseeable future and all the numbers that we're seeing. Now, one of the projects we're talking about today is in Florida, so we're pointing Florida out here. But not only do we have net migration, but job production. So again, Texas #1, Florida #3. All right, so those two states are #1 and #3 in producing jobs, and you can see Texas, 360,000 jobs, Florida somewhere in the 240. Again, that represents the lion's share of new jobs out of the top 10. Let's spend a second on this, because this is data that I think most people don't just clearly recognize. And people are always saying, okay, you got net migration, you have more people coming, you have more jobs, but how is that helping the rental community? Okay, what is that doing for apartments? I mean, aren't people buying houses? Aren't they moving from job to job and they're a little older? And I said, well, yes and no. But let's just take a average home in the US, right around $400,000. Now, this is the affordability gap, right? National average of the cost of owning a home. If you took everything and compare it to mortgage rate, taxes, insurance, everything that it takes to run a home, right? The one thing it does not take into account for is your down payment. So let's just say it's a 10% down payment. Well, that's $40,000 on a $400,000 home. Plus, you're going to be paying $1,100 more per month. Now, those are the numbers at the end of 2023. In the first quarter, the numbers have been catching up, and there's still inflation, and there's still this gap. It's grown to almost or just at $1,300. Now, Texas is closer to the $1,300, and Florida's closer to the $1,100, but still, they're both significant. Okay, that was not the case when I was buying my first home. And I think the next slide. Well, let me point out something here. That gap, if you're in your 20s and 30s, is significant. If that gap is you're in your 40s, 50s, 60s, maybe not as much, but you're probably not buying a $400,000 home. So most of our investors, our accredited investors, are a little older, 40s plus, and that might not be a big number, but go talk to a 25-year-old or a 30-year-old.
That's a complete lifestyle change.
It's significant. It's huge. Households that actually qualify, if you look to the far right, all right, and you look at where we have the red circle there, 2021, 22, 23, the gap is getting so big, so fast that you can see in the decrease in home ownership, the people that can qualify. So where are those people going? They're going to apartments.
There's no other
Rental
option.
product. That's it, rental product. And we'll talk about this a little bit later too, but I'm sure everybody has heard on 60 Minutes and Bloomberg or whatever news source you look, but you have institutional groups coming in and buying single family homes, hundreds and thousands of them. And they are pulling that 1-to-1 where it's a mom and pop renting to somebody. They're pulling that off the market, and they're controlling a big piece of the rental market on the single family homes. So that gap, I don't think there's any way, if you look at those numbers in 2023, we're going to get anywhere close to what you see in 2011 and 2012.
It's just too much to cover.
It is
Too
just too much. So I don't even think that happens in a decade. So if you're looking at the number of renters, and not only that, but lifestyle, that's different. When you and I were growing up, we wanted a home by the time we were 30 years old, period. We're going to get it. I think kids today, young adults, I think they kind of like these resort style pools that they have and all these amenities. I
They're
would have.
traveling, they're
Yeah.
doing all these other things. The last thing
Yeah.
on their list
Yeah.
is buying a home.
But my point being is with that net migration, and you look at these numbers, the variable or the difference between home ownership and renting, and then you look at the affordability component here, we're going to have renters. And Texas and Florida are positioned incredibly well over the next 10 years to do significant things in the housing market for investors. I think the timing is just fantastic right now. And I mentioned in the beginning, I'm going to elaborate on a little bit here, but we have an opportunity, like I said, 2, 3, maybe 4 years to really come in and make a significant difference in people's investments and developers and value add opportunity. And I'm going to talk a little bit about that. And here's one of the things that's happening. All right. So this is just massive. And this is where we're taking our opportunity. If you look at the number of loans or the dollar amount of loans that are maturing on multifamily, it's over 600 billion in the next 3 years. Now, loans that are maturing today in 2024, there's been no interest rate relief. All right. Those guys are scrambling to figure out how to extend the loan, get a new loan, because again, remember I talked about your leverage has gone down from 75 to 60. Valuations have come down, interest rates have gone up. There are people that need help in 24, 25, and 26 because those loans that were initiated 3 years ago, 2 years ago, are all starting to mature in the multifamily space here. And we're going to talk about that and how can we gain from this, but how can the developer and us together benefit, one for our investors and two for the developer. Is that Blackstone? So they've come in and made a $10 billion acquisition to take this company private. So probably thinks we're in the bottom of that wave that we showed on the emotional side. I think they believe that things are getting close to the bottom. It's probably not right at the bottom. It may still have another 6 months or 12, but I don't think it has another 24, 36. I think that is the first piece of news from a qualified institutional capital that is identifying or signaling that, guys, we're there. Okay. We're at the bottom. No, we're not. We may not be at the bottom, but we're really close. So, and I think these are the numbers they look at. Okay. So I just want to put what's happened since 2010. We were talking about, 8, 9, and 10. I wish I had done a lot in 2014, 15, 16 over there. But the point being here is if you look at the construction starts nationally, it has fallen. It's cratered. It's absolutely cratered. Now, what does that mean? Okay. People still need a place to live. All right. And the supply is going to run through the cycle here, I think, in the next 24 months. And think about this. If all your supply is going through the cycle and is getting absorbed right now, but your construction starts have fallen 70%, you're going to see some opportunities in 25, 6, 7. And that is going to be what I think is what Blackstone is looking at too, going, hey, there's not going to be a lot of supply coming out in the next couple of years. That supply is getting absorbed. So there's an opportunity right here. And I can't stress enough, if there is a good, solid way to participate in this economic cycle, I would do it. And we've got one solution that I'm doing personally that that I will be part of. And we're about to show that here in a second.
Time to talk a little bit about what the opportunity is. So
Yeah, so I think investors, you already told us this earlier, we just haven't seen preferred equity in the past couple of years. So can you just kind of define what it is, how it is structured within the capital stack? Just give us kind of a really good idea about
yeah, hopefully I can do it with a picture. Okay, so because I like pictures. Let's see here. Okay, let's look over to the left under the blue bar that says 2021. So most all of us in the past decade, 10, 12 years that are accredited investors, investing in commercial real estate, you were an LP for the most part. All right. And if you look there, you have common equity. Well, the sponsor could come in and say, okay, I'm going to get a construction loan or an acquisition loan of 75%, maybe 70, but let's just say 75 for sake of discussion here. Pretty close. And that was what we saw for, from 2012 to 2022, maybe 2010. That was fairly standard. Well, because of this, perfect tsunami of numbers, interest rates up, valuations down, leverage down, some banks are overexposed. You've seen that capital stack shift. Well, now that senior debt has gone down to closer to 60%. So what is that sponsor going to do to fill that gap? Well, he can raise a little more common equity, all right, do a capital call, put a little more money in, and or they can come to people like us and say, hey, we need this gap for you can you fill it for a period of time, say 2, maybe 3 years, short term, and we will put you above the common equity. So what happens here is that you have distribution rights above the common equity. So the senior debt obviously first, then we would come in with the preferred equity and we would receive our payment before the common equity would receive theirs. Now, what's interesting is we've received multiple offers over the last year and a half to fund deals. And when we underwrite them or when they're presented to us, they're literally presented in, that the IRR or the return is going to be somewhere in that 10 to 14%. And that's the common equity. Now, remember, it's behind the preferred equity. Right. And I kind of think to myself, I go, can I literally take this to my common equity investors and say, you know what, I can pay you a projected 10 to 14% on a project, or I can give you a preferred equity, which is contracted. Now, we don't get the upside, but we get paid first. I'll give you a preferred equity at 12%. And it's just not even worth it. Okay. You're going to take the preferred equity. And if you think about it, the common equity at 10% or the preferred equity at 12, you're getting a 20% greater return, potential on that than you would. So why would you do common equity? By and large, I don't see any reason to take that additional risk, when you have a more or less of a contracted payment that sits above the common equity. So that's a picture of what it looks like. So that's where we are today. Now, the how and the why. So why are we doing this and how are we going to do it? Let's talk a little bit about what's happening here. Just so you guys aware, we're not the only one talking preferred equity.
No.
All our industry trades right here. I'll give you 5 seconds to kind of look at those headlines. But preferred equity, and for those groups that can provide it, it is literally a safety net. And I used this phrase the other day. I'm going to use it again. But it's like this Trojan horse gets to go in, but it comes in with an olive branch. Not the way the original Greeks did to Troy. But anyway, I digress slightly. But it literally is you get inside the deal and you get a preferred seat at the table. All right. So and this is going to be an opportunity for groups like us over the next 2 to 4 years. I'm going to talk a little bit more about where that opportunity leads. Why don't you take this and talk about what's different with the common equity and the preferred equity and why these are also important.
Capital stack seniority. So of course the debt gets paid first and then it would go to the pref and then common would get paid out. So you really have that safety and security within that capital stack that we're not used to with deals that we've presented in the past. Another thing that we have not touched on yet is immediate cash distribution. So with that being said, you're going to get quarterly distributions paid out on this type of investment. Other thing is a short term. So we have some of these are, I think this one's 14 to 26 months. So short term, you put your money in, of course, it's a fixed rate and you have that defined timeline. Then you can go deploy elsewhere after that. And just the opportunistic timing, this window of opportunity that we're giving investors to stop sitting on your money, put it somewhere safe, get it going for you, and don't miss those opportunities, like you said.
Get prepared.
And regret those opportunities that are at this time. So
Put yourself in the game.
yes,
Okay.
absolutely.
And we heard this from our investors for the last couple of years. Hey, I need more cash flow. I need more distributions. I don't want to be in a deal 7 years, 5 years. And so you asked and we provide, okay? Because, you know, getting your money working for the next year or two and getting, you know, instead of sitting on the sideline and letting inflation erode it at 3, 6, 8% a year, you're losing money. You know, and I'm not going to tell anybody to put all their money in one deal. You absolutely need cash on the side for whatever reason. But boy, if you have investment capital and you need it in something short term that is really locked down, you're not going to do much better than this, especially getting a 12% annualized return. This is the feature benefit kind of sort of between the investor and the sponsor developer, and you know, for both of us. But one is that we're absolutely providing a solution. Now we're providing a solution for the developer because they've got this gap where they need to get construction completed. They need to get stabilized in rent, and they need to buy some more time. Now, what does this do for us? This gets our investors in the game. Okay, this gets them a 12% return, paid quarterly, short term, meaning anywhere from, you know, I think our shortest one we're looking at is 14 months, and some of our longer ones are right at 30 months, but not you know 4, 5, 6, 7 years. They're going to be in that 3-year or less range. And you know, when the developer gets to use his capital to survive to the next cycle, and we get to use this money to make a great return in a very safe, secure position, it's a win for both of us. Now, people ask this question, you know, well, how do you know it's a good deal? Well, and I tell them, I say, guys, we underwrite it like we're owning it. And here's why. In the event that we do end up taking it over, I don't want to take over some project that we know nothing about. You know, not just for that money. There's enough deals that we know in Texas and Florida, and developers and opportunities and growth patterns and demographics and all that. So we're underwriting this not just for our position in the capital stack, but we're underwriting it as if we could own it. And we might, you know, there's a couple different ways it can happen, and I'll talk a little bit about them. But the other thing is, you know, we talked about this, and I'm gonna say it again, but earning that kind of position of a safer, more secure investment that pays double-digit returns. And again, that's what our investors asked for, and that's what we focused on in making sure we structured it so that they get short-term cash distributions. Now, this one, I think this is where we're talking about possibly could own it. And I'll say this is not 2008, 2010, where the entire market is distressed, okay? There was a feeding frenzy. There were deals being cut all over the place. It was pretty nasty. But we're going to get a courtside seat into the asset so that we can see the asset performance, and we're getting paid to do that. So we're being brought in. We get access to all the data, property management, everything. And so we're getting this information, and we are in a position to take over the asset under some very unusual circumstances, but more probable is that we would be buying that asset. Okay, acquiring that asset at a probably below replacement cost. All right, because the developer may say, you know what, I'm a merchant builder. My business runs on turning deals every 3.5 to 4 years. I can't stay in this long term. I need to exit. And for them to do that, and we're right there, and we're an acquirer of Class A asset in Texas and Florida in key areas, I very much could see us picking up a couple of assets a year for the next few years. Why don't you talk a little bit about this asset in Florida? This is one of a few that we have in the pipeline, but go ahead. I'll let you pick it up from here.
Absolutely. So this one's located in Fort Myers, Florida, the Taverna at the Forum. So it's right outside of a master plan kind of area, the Forum, with lots of shopping and different things that are close by. It is a Class A multifamily wrap style, which means it kind of wraps around that main area. 251 units. The big thing about this, which you can see the picture right behind you there, I-75. So major artery right behind it, lots of visibility. You've got all this traffic flow right by the asset. And then the progression on the construction is 80%. So plus at this point,
80+%, yeah.
yes. So you can see it's already being built out. We're getting very close. Again, it's the developer needs that extra push to get past that construction and get this project to stabilization. But we already touched on kind of the growing workforce, the affordability component here that's driving those rents, that's driving the demand for this. And we have a repeat partner here. So we've already closed out 2 assets with
It'll be our third project with this development partner.
Very successful. They were here in Texas, but he's developed in Florida for many years. And this will be a great asset for him.
I don't think we would have gone to a new person in Florida. We've done 2 other projects here in Texas with him. Probably have a fourth one. Actually, we're considering. But I can't stress enough. This is a current picture. That picture's 3 weeks old, so you can see that the project is getting close to completion. So when you get that development behind you, the construction behind you, then you almost get to like say, okay, we've gotten over the heavy part. Now the next piece of heavy lifting goes to the property management company and the sponsor to do leasing and stabilization. High demand in this area too, very high demand.
Yeah.
Projected right now is mid to late June for the first occupant.
Just around the corner.
Just a couple months.
Yeah.
So let me talk a little bit about the capital stack, and I think this is incredibly important to understand where we sit in the capital. So the capital expenditures at 100%. We don't typically want to be north of 75. So we would have at least 25% of common equity or some other funding source behind us. So if you look at this, the top line, senior debt, there's a loan at Wells Fargo, 39 million. And then our preferred equity is coming in at 8.6. So combining those two, that represents 69% of the capital in this deal. So we're under that 75%, clearly under that 75%. Would we go up to 80 depending on the deal, but 75 is kind of our mean where we start and we want to work backwards. The lower we get it, the better for us because it's less exposure at the end of the day. So I just want to point that out, 69%, and then all the rest of the money is behind us from a payment structure, paying out proceeds.
Fort Myers. So yes, I mean, anybody that doesn't know Florida, it's the fastest growing places nationwide in 2023, number 3 on the list. Amazing, big.
And I was just there a month ago, and there were construction cranes, miles and miles of them. I mean, highway expansions, construction cranes. It did not look like we were in any non-development market at all. I mean, there was development all around it.
You've got this annual growth, 2.5% of the population. So yeah, since 2000. So renter occupied, you got 29%, and your labor force is solid.
It's a jobs renter market. Jobs, renter market. So tremendous amount of growth. Let's take a second and kind of walk through the structure of an investment. We're just going to use 100,000 as an example. Now, look at the very top middle. I think this is important because this is not terms that we're typically discussing with our investors. But you see the words up there, 7% current pay and 5% deferred pay. Well, obviously, this thing's not generating any revenue.
Right.
Okay. So you're going, well, how do you get 7% current pay? Well, part of that $8 million investment is prepaying $1 million in interest. And we use that interest to make those payments to the investors. The 5% deferred pay is just that. You're accruing that 5%. It's deferred until the end. And at exit, that's when you'll receive that. So 7% is paid current, and then the 5% is accrued and deferred until time to exit. You would see a $7,000 payment on 100, another 7,000, and then the remaining 12 plus your $100,000 investment. So this is a pretty typical type structure. You're going to see current pay and deferred pay and pref equity from not only just us, but anybody else out there doing that.
We are focused on multifamily assets. Of course, the last couple of years have been great, and a lot of these calculations here are off our common equity exits. But we're at a 2.6 multiple return to our investors, and around that 4-year average on the whole term. So just transactions were up to 590 million, and of course units over the 3,000 mark. So
yeah. So and I want to point something out. The model that we were employing previously, we were working with merchant builders and developers where they build it, stabilize it, sell it. Okay, so that's why you see the 4.3 years. Most of these guys wanted to be out in 4 years, no more than 5. Okay, because most of their loan terms are 5-year loan terms. The strategy that we're using now, driven by the market and investor demands and sponsor requirements, you're not going to, this isn't a multiple market today.
Right.
Okay. It's a safety, it's a security, it's a cash flow, it's a return of your money with a nice return, 12% on your capital. The thing that I want to point out, and we said it in an earlier slide, is in the event we are in a position and the asset is right, we may have the opportunity to acquire that asset. Okay. And then we do that acquisition, we'll be driving more to numbers like that.
Right.
Okay.
So that would be probably more the
we'll be
common
driving,
equity that we would be entering in at that.
Right. We'll be driving more to, cash flow with an existing asset, new debt, and working that, in that 5-year mark so that we can actually do returns just like that. So. Robin, this is you.
Yes. So we hope that you enjoyed this presentation. Just wanted to make sure that you are pointed in the right direction. If you are interested, view the offering memorandum, all our materials and the details on this specific deal. Go ahead and sign the soft commitment if you would like to reserve your position today. And then I'll reach out to you directly. We'll get you set up in our investor portal. It's seamless, very easy. Everything's done electronically, funding, wiring. I'll help you through all of the steps necessary. So we do have a minimum of $50,000 to take on a position. It is open to accredited investors only.
Yep, it is. And I can't stress enough. It's kind of a unique market right now, weird market, scary market, but my experience and some of the people I work with and talk to and on a very frequent basis who are far smarter than me, but we're in probably the bottom of this kind of yuck that we're in. And I know it can be a little awkward sometimes when you're going, hey, I haven't done a pref equity but if you understand that where the opportunity really lies, getting a nice return based off of a class A asset and you have all that common equity behind you, that's your security and safety. And then you're actually in the deal. And then you get to make the decision, do I want to stay in it? Should we go forward? Or I just want to take my chips off the table and go. That's your choice, not our choice for you. That's going to be your choice. So, because our agreement with you is that pref equity, we're in, we're out. But if you're in and that next opportunity comes to us, you'll be the first one that has that opportunity to take it forward. So, so this is it's a strategy and we're executing on it. And we have several opportunities coming up over the next 12 to 14 months. This one is immediate. And one of the things I really like about this one is that we're going to see, because it could be as short as like 14 to 20 months, we're going to have that opportunity to step into this deal, I think, within less than 2 years, from an acquisition and continue to, cash flow this deal. So that's my last 2 cents. So guys, thank you very much. I appreciate everything. Please reach out to Robin or myself. Phone numbers are on the website.
Yes.
Yep. So, all right. Thanks, guys.
Thank you so much.
Bye.